It's 1945. A 14-year-old boy stands in an Omaha barbershop staring at a coin box. Inside are 80 nickels, $4. His hands are shaking slightly as he counts them. He invested $25 1 week ago. The machine has already returned 16% of his capital in a single day. That 14-year-old will become the most successful investor in human history. But he won't do it through stocks. Not yet. He'll do it through pinball machines, barbershops, and a company that doesn't exist. The boy's name is Warren Buffett, and this is the story of how a used pinball machine purchased for $25 set him on a path to become worth over $130 billion. But there's something you need to understand first, something that explains everything that comes after. Warren Buffett didn't want to be rich, he wanted to be free, and he figured out the difference before most people learn to drive. Warren Edward Buffett entered the world on August 30th, 1930 in Omaha, Nebraska. The timing was catastrophic. The Great Depression had just begun. His father Howard was a stockbroker whose firm had failed in the crash. The family experienced genuine financial hardship, the kind that leaves marks. By age 6, Warren was already working. He bought 6 packs of Coca-Cola from his grandfather's grocery store for 25 cents. Then he walked door to door through his neighborhood, selling individual bottles for 5 cents each, 20% profit margin. He was 6 years old. For Christmas at age 7, Warren asked for a specific gift. Not a toy, not a game, a book called Bond Salesmanship. He read it cover to cover. By age 10, something had changed in his brain. He memorized the population of every major American city. He counted the number of bathtubs in Omaha using Census Bureau data just to see if there was a business opportunity in bathroom fixtures. He collected bottle caps outside grocery stores and sorted them by brand to analyze which soda sold best. His father noticed. In 1940, Howard Buffett took his 10-year-old son on a trip to New York City. They visited the floor of the New York Stock Exchange. Warren watched the traders, memorized the ticker tape system, had lunch in the members' dining room. Later, he would say that visit changed everything. 1 year later, at age 11, Warren Buffett bought his first stock. 3 shares of City Service Preferred at $38 per share. Total investment, $114, pooled with his sister Doris. The stock immediately dropped to $27. Warren held nervously. When it recovered to $40, he sold. City Service eventually rose to $200 per share. Warren Buffett learned a lesson that day that would define his career: patience pays, and selling too early costs fortunes. He was 11, but stocks were just the beginning. Warren had bigger plans, and they involved something far more mechanical. In 1942, Warren made an announcement to his family. He was 12 years old. "I'm going to be a millionaire by age 30, he said, "or I'll jump off the tallest building in Omaha." Nobody laughed. They knew he was serious. 1 year later, his father Howard was elected to Congress. The family moved to Washington, D.C. Warren saw opportunity immediately. He took a job delivering newspapers for the Washington Post and Times-Herald. But Warren didn't just deliver papers. He optimized. He combined multiple routes into a single delivery path. He targeted apartment buildings, specifically high density, minimal travel. He calculated the optimal walking pattern to minimize time per paper. Within months, he was running 5 combined routes. His territory covered 500 homes in Spring Valley, one of the wealthiest neighborhoods in Washington. The tips alone from those customers exceeded what many adults earned. Monthly income at age 13, $175. That same year, Warren filed his first federal income tax return. On it, he claimed his bicycle as a $35 business deduction. The IRS accepted it. By age 14, Warren had accumulated $2,000 in savings. In 1944 dollars, adjusted for inflation, that's $35,000 today, earned by a 9th grader. Then he did something that would set the pattern for his entire life. He bought a farm, 40 acres in Nebraska. Purchase price, $1,200. Warren rented it to a tenant farmer for passive income. He never personally farmed a day in his life. He was 14 years old, and he already understood that assets work while you sleep, but the farm was just a side project. Warren had discovered something else, something with higher returns and faster turnover, something that would teach him the real secret of wealth. The year was 1945. Warren was now 15, back in Omaha, finishing high school. And he had a problem. He wanted to scale. Paper routes paid well, but they required his time. Farms generated passive income, but the returns were slow. He needed something that combined the best of both. He found it in a barbershop. Warren noticed that men waiting for haircuts had nothing to do. They sat on wooden benches, staring at the wall, bored. Captive audience. 15 to 30 minutes of waiting time with no entertainment. He saw opportunity where others saw empty space. Warren approached his friend Don Danley with a proposition. Danley was mechanically skilled. He could repair machines. Warren could handle the business side. Together, they would form a partnership. They pooled their money and bought a used pinball machine for $25. Now they needed a front. Omaha's coin-operated machine business had a problem. Organized crime controlled most of it. Mobsters ran the pinball racket in major cities across America. Two teenagers walking into barbershops talking about pinball machines would raise suspicions, so Warren created a fiction. He called it Wilson Coin-Operated Machine Company, professional letterhead, implied corporate structure. There was just one detail missing. There was no Wilson. When suspicious men came asking questions, and they did, Warren had a response ready. We just work for the owner. Some guy named Mr. Wilson. The men left without incident. The company's first machine went into Frank Ereco's barbershop in Omaha. The revenue split 50-50. Frank got half for hosting. Wilson Coin-Operated Machine Company kept the rest. Day one revenue $4. 80 plays at 5 cents each. Warren collected those nickels and did the math in his head. At this rate, the machine would pay for itself in 2 weeks. Every day after that was pure profit. He reinvested everything. Within months, Warren and Don had 7 machines across Omaha. Peak weekly revenue, $50 gross, $25 net after splits. Warren later described his reaction to that first $4 day. I thought I had discovered the wheel, but he'd actually discovered something more important, something he would spend the next 70 years perfecting. 12 business taught Warren Buffett the mathematics of compounding. Each machine cost $25. Each machine paid for itself in roughly 2 weeks. Each machine then generated pure profit indefinitely. And each machine's profits could purchase another machine. 1 became 2, 2 became 4, 4 became 8. Warren didn't see pinball machines. He saw, in his own words, employees that never got sick, never complained, and works 24 hours a day. The structure was elegant. 0 management fees. Warren took no salary. Profits split 50-50 with locations after expenses. Every penny of Wilson Coin-Operated share went back into expansion. By 1946, the operation was running smoothly. 7 to 8 machines generating consistent cash flow. Warren was 16 years old. Then he made a decision that seemed strange at the time. He sold everything. A returning World War II veteran wanted to buy the business. Warren and Don sold Wilson Coin-Operated Machine Company for $1,200. They split the proceeds evenly, $600 each. Warren had turned $25 into $600 in under 12 months, a return of over 2,300%, but the real return wasn't money, it was knowledge. He learned how to identify undervalued assets, how to negotiate placement deals, how to structure revenue splits that aligned incentives, how to use leverage other people's resources to multiply his own capital, and he'd learned that compound growth isn't about speed. It's about consistency. That $1,200, if invested at Warren's lifetime average return rate, would be worth approximately $30 billion today. He was 16 years old. And he was just getting started. Warren graduated high school in 1947 with a net worth of approximately $5,000. He enrolled at the University of Pennsylvania's Wharton School. He hated it. The curriculum was too theoretical. The professors, Warren later claimed, didn't know as much as I did. After 2 years, he transferred to the University of Nebraska. He completed his degree in 3 years total, graduating at 19. Then came the rejection that changed everything. Warren applied to Harvard Business School in 1950. He was 19 years old but looked younger, perhaps 14 or 15. The interview lasted approximately 10 minutes. The interviewer was dismissive. Warren was rejected. The reason, reportedly, was that he seemed too young and immature. Years later, Warren would call this rejection the best thing that ever happened to me. Because if Harvard had accepted him, he never would have gone to Columbia. And if he hadn't gone to Columbia, he never would have studied under Benjamin Graham. Graham was the father of value investing. He'd written the Bible of the industry, The Intelligent Investor. Warren had read it in 1950 and described the experience as seeing the light. At Columbia, Warren sat in the front row of Graham's securities analysis course. He asked more questions than any other student. He absorbed everything. Benjamin Graham rarely gave A grades. Warren Buffett received the only A+ Graham ever awarded. Graham later said, Warren had an unusual mind. He could see things in a balance sheet that others missed. In all my years of teaching, he was the only student to receive an A+. But Warren wasn't satisfied with just learning from Graham. He wanted to work for him. After graduation, Warren approached Graham about a job at Graham-Newman Corporation. Graham politely declined. The firm was small and fully staffed. Warren offered to work for free. Graham still said no. So Warren tried a different approach. He tracked Graham's travel schedule and cornered him in a New York train station between trains. He pitched himself again. Graham was impressed by the persistence. Eventually, he relented. In 1954, Warren Buffett joined Graham-Newman Corporation at a salary of $12,000 per year. For 2 years, he learned value investing directly from its inventor. He read annual reports at his desk during lunch. He analyzed balance sheets while others socialized. He absorbed decades of wisdom in 24 months. Then, in 1956, Benjamin Graham retired. He offered Warren a partnership in his firm. Warren declined. He wanted to go home. He wanted to work alone. He wanted to think. Omaha is a good place to think, he explained. No one is whispering hot tips in your ear. Graham thought it was a mistake. Newark was where the money was. Warren disagreed. He returned to Omaha to start his own firm. In his suitcase was a plan that would make him a millionaire within 4 years. On May 1, 1956, Warren Buffett formed his first investment partnership. The location was unusual. The sunken living room of his rented home in Omaha. 7 investors committed capital. Total raised $105,100. Dr. Edwin Davis contributed $100,000. Charles Peterson and his wife Elizabeth added $30,000 combined. Warren's sister Doris put in $10,000. 3 other investors contributed smaller amounts. Warren Buffett's contribution, $100. This wasn't oversight, it was strategy. Warren had approximately $175,000 in personal net worth at this point. He deliberately kept most of it outside the partnership for diversification, but by contributing just $100 while managing over $100,000, he was using other people's money to generate returns he would share in. The fee structure was revolutionary for 1956. Management fee, 0%. Warren took no salary. Performance allocation, 25% of profits above a 6% annual return. Translation, partners received the first 6% of any gains. Warren only participated in returns beyond that threshold, and if there were losses in any year, they had to be recovered before Warren took any performance fees. This structure aligned incentives perfectly. Warren only made money if his partners made significant money first. The deal was so attractive that partners considered it generous. It wasn't generous, it was genius. If Warren generated 20% returns, which he kept 25% of the 14 percentage points above the hurdle, that's 3.5% of total assets annually, on a growing pool of capital, and Warren never took distributions. His share compounded tax-deferred inside the partnership structure. The first full year of operations, 1957, validated the approach. The Dow Jones Industrial Average fell 8.4% that year. Buffett partnership rose 10.4%. Outperformance 18.8 percentage point, 4%. Outperformance 18.8 percentage points. By 1958, partnership assets had grown to $303,000. Returns that year 40.9%. By 1959, assets reached $473,000. Returns 25.9%. Something else happened in 1959. At a dinner party, Warren met a lawyer from Los Angeles named Charlie Munger. The introduction came through mutual friends. Both men recognized kindred spirits immediately. That meeting would eventually create the most successful investment partnership in history. But that comes later. By 1960, Buffett Partnership managed approximately $1.9 million. That year's return, 22.8%. The Dow Jones fell 6.2%. Outperformance, 29 percentage points. And Warren Buffett's personal stake in the partnership crossed $1 million. August 30, 1960, Warren Edward Buffett turned 30 years old. He had fulfilled the promise made to his family 18 years earlier. He was a millionaire, one of the youngest self-made millionaires in American history. The journey from that first $25 pinball machine to $1 million had taken 15 years. Compound annual growth rate, approximately 29.5%. On his 30th birthday, Warren worked from his home office in the sunken living room. He read annual reports, analyzed potential investments, calculated intrinsic values. His wife Susan and 3 young children were elsewhere in the house. Warren was present but not present, his mind perpetually engaged with numbers. There was no celebration, no party, no champagne. Warren later explained his thinking. Turning 30 with $1 million was nice, but I was already thinking about the next 10 million. He bought breakfast at McDonald's. He drove the same car he'd had for years. He wore conservative suits that were functional, not fashionable. His house, purchased in 1957 for $31,500, was modest and unremarkable. The man worth $1 million lived like he was worth $100,000. If you buy things you don't need, Warren would say, you'll soon have to sell things you need. The million was just the beginning. By 1961, partnership assets reached $7.2 million. Returns that year, 45.9%. By 1962, Warren began acquiring control positions in companies, not just minority stakes. One company caught his attention, a struggling textile manufacturer called Berkshire Hathaway. He bought shares at an average price of $7.50. By 1969, the partnership managed $105 million. Warren dissolved it, offering partners a choice, cash or shares in Berkshire Hathaway. Most chose cash. Those who kept Berkshire became enormously wealthy. The compounding never stopped. At age 35, Warren's net worth was $7 million. At 40, $25 million. At 50, $140 million. At 60, $3.8 billion. At 70, $28 billion. Today at 93, approximately $130 billion. Warren still lives in the same house he purchased in 1957 for $31,500. Current value, approximately $1.4 million. He calls it the third best investment I ever made. He still drives himself to work at Berkshire Hathaway headquarters every day. He still eats breakfast at McDonald's nearly every morning. The order depends on the stock market. Good market, $3.17 for a bacon, egg, and cheese biscuit. Average market, $2.95 for a sausage biscuit. Bad market, $2.61 for 2 sausage patties. He has pledged 99% of his wealth to philanthropy. There are details that deserve remembering. Harvard Business School rejected Warren Buffett. He never donated $1 to Harvard. Columbia, where Benjamin Graham taught him everything, has received millions. The pinball machines that started it all likely ended up in a scrapyard decades ago. But if that original $25 had compounded at Warren's lifetime average rate, it would be worth approximately $150 billion today. Don Danley, the partner who fixed the machines, remained friends with Warren. He pursued a career in manufacturing while Warren pursued a career in capital allocation. Same starting point, different trajectories. The fake Mr. Wilson from Wilson Coin-Operated Machine Company never existed, but his name protected two teenagers from organized crime long enough to build their first fortune. Warren still reads 500 pages per day. Financial documents, annual reports, industry analyses. He's been doing this since age 10. And every morning, before the market opens, one of the richest humans who ever lived counts his money. Not to admire it, to deploy it. The 12-year-old who promised to become a millionaire by 30 kept his promise. The promise he made after that to keep compounding until it changed the world, he's kept that one too. The pinball machines are gone. The barbershop closed decades ago. The $4 in nickels were spent long ago on the next investment, but the lesson from that first collection day in 1945 still echoes through financial history. Find an asset that works while you sleep, reinvest the returns, and never stop compounding. Warren Buffett didn't invent this formula. He just started earlier than anyone else. Age 6, selling Coca-Cola door to door. Age 11, buying his first stock. Age 14, buying his first farm. Age 15, building a pinball empire. Age 30, becoming a millionaire. Every year after that, doing exactly the same thing, just with more zeros. The house at 5202 Underwood Avenue still stands, gray stucco, 5 bedrooms, no security gate, no visible signs of wealth. Inside one of the